Welcome to the Deep Dive. Today, we're diving into something most people only think about when, well, disaster hits. Homeowners insurance. If you're like most folks, you probably picked your policy based on the monthly payment, right? How cheap can I get it?
Mm.
Our mission today is to get you past just comparing those premiums. We want to really dig into how these policies work, what you actually need, where the surprising risks are hiding.
And those financial traps, the coverage gaps that can really bite you.
Exactly. It's about making sure that if the worst happens, your policy actually helps you, that it's not just, an expensive piece of paper.
That's the key thing to shift in your mind. This isn't just about home upkeep. It's about financial survival if something catastrophic happens.
Right.
So the basic idea, the core purpose, is to cover costs you just can't handle yourself.
Yeah.
And what you need, the policy limits, it really boils down to a few main things.
Okay, what are they?
Your home's size, its age, any special features it has, what construction costs are like where you live, and of course, the value of all your stuff inside.
Okay, let's unpack that. Starting with probably the single most important number in that whole policy packet, dwelling coverage. I think it's usually called coverage A.
That's the one. Coverage A, the dwelling limit, that's the absolute maximum the insurance company will pay to rebuild the actual structure of your house.
Okay, structure only.
Right. And here's the really crucial bit. This limit is not the same as your home's market value.
Okay, explain that.
Well, market value includes the land your house sits on, how nice the neighborhood is, the schools, all that stuff. Your insurance policy, it doesn't care about the land value. It only covers the cost of the physical materials and the labor needed to reconstruct the house itself.
So wait, if I bought a house for, say, $700,000 in a hot market, the actual insurance limit I need for the dwelling part might only be, like, $450,000?
Exactly. Could be. You need a solid estimate of what it would actually cost to rebuild.
So how do you figure that out accurately? Agents must have tools for this.
They do, yeah. They use specialized calculators. But a good rule of thumb, something the Insurance Information Institute suggests, is to take your home's total square footage and multiply it by the current local cost per square foot for construction.
Local costs.
And current cost.
And that current part needs checking. Regularly.
Okay, because here's where it gets, honestly, a bit scary. The data we looked at shows the impact of inflation on building costs has been massive.
Oh, absolutely.
We found that replacement costs, materials, labor, everything, they jumped a total of 55% just between 2019 and 2022.
55%. Just think about that for a second.
It's huge.
It's nearly 4 times the general inflation rate, the CPI, over that same period. So what does that mean for you listening?
Yeah.
It means if you set your coverage limits even just 3 or 4 years ago and haven't updated them, you are probably way underinsured right now.
Seriously underinsured.
Seriously. Imagine a total loss. Your limit is $400,000. But because of that inflation, it now costs $600,000 to rebuild your exact same house.
Yeah.
That $200,000 difference, that comes out of your pocket. That's the real disaster scenario right there. And you mentioned coverage A is the foundation.
Okay.
So getting that number wrong creates like a ripple effect.
A huge ripple effect, because the other parts of your standard policy are usually calculated as percentages of that coverage A limit.
Okay, like what?
Well, coverage B, that's for other structures on your property, maybe a fence, a detached shed, or garage. That's often set at 10% of coverage A.
Right.
Then coverage C, your personal property, furniture, clothes, electronics, all your stuff. That's typically somewhere between 50% and 70% of coverage A.
Wow. Wait.
And even coverage D, additional living expenses, that's what pays for you to live somewhere else, like a hotel or rental, while your house is being repaired. That's also tied back as a percentage of A.
So if your main dwelling coverage A is too low because you haven't accounted for inflation?
Then all these other coverages are too low as well. Everything gets dragged down.
Beyond inflation, what else can make that rebuild cost higher than people expect? You mentioned age.
Absolutely. Age is a big one. If your home is, say, 30, 40 years old or older, it might cost a lot more to rebuild today than you think, because when you rebuild, you generally have to meet all the current building codes. Electrical, plumbing, safety standards, they've all changed.
The codes.
And bringing an older structure up to those modern codes can add significant cost. So if you do have an older home, you should really look into adding something called an ordinance or law endorsement.
Ordinance or law. Okay.
Yeah, it specifically helps cover those extra costs related to code compliance during a rebuild.
Okay, so let's say we've nailed down the right coverage limit, accounted for inflation, and maybe added that ordinance thing.
Right.
Now, the next hurdle is how you actually get paid after a claim, right?
Yeah.
This whole ACV versus RCV thing seems critical.
It is absolutely critical, and it's a major source of confusion and, frankly, disappointment for homeowners after a loss.
Oh.
Let's break it down. ACV stands for actual cash value.
Actual cash value.
With ACV, the insurance company deducts for depreciation, age, wear, and tear. It all lowers the payout.
Okay, give me an example.
Sure, let's say you have a really nice TV, but it's, 5 years old. Or maybe it's your roof that got damaged and it's 15 years old.
Yeah.
With ACV, they figure out what that TV or that section of roof was worth right before it got damaged, considering its age and condition. They don't pay you what it costs to buy a brand new one today.
So ACV is like getting paid the used value of your stuff.
That's a good way to put it. Now, replacement cost value, RCV, that's different.
Okay, how?
RCV pays the cost to replace your damaged item with a new one of similar kind and quality today without subtracting for that depreciation.
Okay. That sounds much better.
It usually is in terms of the payout amount.
Let's use that furniture example from our research because the numbers really make it clear. Say you bought a sofa set 5 years back for $6,000.
Right.
Today, to buy a similar new set, it costs $7,000 because the prices went up.
Right.
Over those 5 years, let's say the old sofa depreciated by maybe $2,100, and you've got a $1,000 deductible on your policy.
Got it. 6K original, 7Cal replacement, $2 1K depreciation, 1K deductible.
Okay, so under ACV, actual cash value, they take the replacement cost, $7,000, subtract the depreciation, $2,100, then subtract your deductible, $1,000.
Right.
What does that leave? Just $3,900.
Right. Not enough to buy the new $7,000 set.
Not even close. Now, same situation, but with RCV, replacement cost value.
Okay.
They take the full replacement cost, $7,000, and just
Yeah.
subtract your deductible, $1,000. The payout is $6,000.
Big difference.
That's a $2,100 difference just on one furniture set. Imagine that across your whole house. But I bet RCV costs more in premiums, right?
Generally, yes. An RCV endorsement on your policy will usually mean a higher premium than an ACV-only policy.
So how do you convince someone who's really focused on keeping that monthly bill low that paying extra for RCV is worth it?
You remind them what they're actually buying. You're buying protection against having to eat that depreciation cost yourself. Think about a major fire or tornado. Maybe $100,000 worth of your stuff is destroyed. With ACV, the depreciation on all that could easily be tens of thousands of dollars you don't get back. RCV costs a bit more upfront, but it's essentially insuring you against that massive depreciation hit, making sure you can actually replace what you lost with new items. It's about being made whole again.
Makes sense. It's paying a bit more now to avoid potentially huge costs later.
Exactly. Now, shifting gears a bit, let's talk about Coverage E personal liability. This is another area people often don't think much about until they need it.
Right, liability. That's if someone gets hurt at your place or you accidentally damage their property.
Yes, it protects you financially if you or someone living in your household is found legally responsible for injuring someone or damaging their property. And what's really interesting is that this coverage isn't just limited to things happening at your home.
Oh, it extends beyond your property line.
It often does. So it's not just the classic someone slips on your icy sidewalk scenario. If, say, your kid is playing baseball in the park and accidentally breaks a neighbor's expensive stained glass window.
Your homeowner's liability could cover that.
It potentially could, yes. That's why understanding your liability limits is so important and tailoring them to your life.
So certain lifestyles or features might mean you need higher limits.
Definitely. If you entertain a lot, host big parties.
Okay.
Or if you have what the insurance world calls attractive nuisances, things that might attract kids and pose a danger, like a swimming pool.
Especially one with a diving board, I bet.
Exactly. Or a trampoline. Even having young children or certain types of pets can increase your liability risk profile. In those cases, the standard liability limit might not be nearly enough.
And if the standard limit isn't enough, what's the solution? That's where umbrella insurance fits in.
Precisely. Umbrella insurance is basically extra liability coverage. It sits on top of the liability limits you already have on your home and auto policies.
How much extra coverage are we talking?
Typically, umbrella policies start at $1 million in additional coverage and go up from there. They're often recommended for people with a higher net worth or those specific risk factors we mentioned, pools, rental properties, etc.
So how does it work in practice?
Let's say you have $300,000 in liability coverage on your homeowner's policy. Someone has a serious accident at your home, sues you, and wins a judgment for $500,000.
Okay, your policy pays the first $300K.
Right. But you're still short $200,000. If you have a $1 million umbrella policy, it kicks in and pays that remaining $200,000.
Protecting your savings, your house, other assets.
Exactly. It prevents a lawsuit from wiping you out financially.
Okay, let's circle back to coverage C, personal property. You mentioned having RCV is better for payout, but actually getting that payout smoothly relies on something else, right? The inventory.
Absolutely. A detailed home inventory is non-negotiable if you want a smooth claims process, especially for a large loss. And I don't mean just a quick list scribbled down.
What makes a good inventory?
You need a digital record. For each significant item, list its name, a good description, maybe the brand and model number, what you paid for it, ideally with a scanned receipt or credit card statement.
Photos are probably good too. Or video.
Photos or video are excellent proof. And crucially, estimate what it would cost to replace it today.
Okay, make the list, get the proof, and then where do you keep it?
Not just on your computer at home.
Right. I know people who do that, or use a USB stick they keep in a desk drawer.
That's a huge mistake. If your house burns down or gets destroyed...
An inventory goes with it.
Exactly. You need to keep that digital copy somewhere else, store it in the cloud, email it to yourself, keep a copy at your office, give one to a trusted family member. Just make sure it survives if your house doesn't.
Needs to be accessible after the disaster.
Yeah.
Makes sense. Now, within personal property coverage, you mentioned a potential trap, sublimits.
Yes, sublimits. This catches so many people off guard. Even if you have a high overall coverage C limit, say $100,000 for all your personal belongings, your standard policy puts much lower maximum payout limits on certain categories of high-value items.
Like what? How low are we talking?
It varies, but it can be surprisingly low. For example, that $100,000 policy might only pay out a maximum of, say, $1,500 or $2,500 for all jewelry lost in a theft.
Seriously, even if you lost a $10,000 ring.
Correct. Or they might limit payouts for things like firearms, silverware, furs, collectibles, or even computer equipment. If you own items in these categories that are worth more than those standard sublimits,
You need something extra.
you need what's called scheduled personal property coverage. It's an add-on, an endorsement. You list specific high-value items like that expensive ring or artwork or a collection, provide an appraisal, and insure them for their full value, completely bypassing those low standard sublimits.
Okay, so you schedule the item separately. Got it. We've talked a lot about what is covered, but what about the things that are almost always excluded, the things people wrongly assume are covered?
This is critical. Understanding the exclusions is just as important as understanding the coverages. The two biggest ones, the ones that cause the most financial devastation because they're so common, are flooding
Flooding?
and earthquakes. Standard homeowners policies basically never cover damage from floods. Doesn't matter if it's from a hurricane surge or overflowing river.
Never.
Never. You need a separate flood insurance policy, either through the National Flood Insurance Program, the NFIP, or from a private insurer.
And earthquakes.
Also excluded. Even if you live in California or another high-risk area, you need to buy separate earthquake coverage, usually as an endorsement to your main policy or a completely separate policy.
Okay, flood and earthquake are out unless you buy them separately. What other surprising gaps are there? Things people might think are covered but usually aren't.
Well, remember, policies are generally for sudden and accidental damage. They typically exclude things considered maintenance issues like general wear and tear or damage from neglect.
Give me an example of that.
Okay, say a pipe suddenly bursts inside your wall and floods the room. That's usually covered sudden and accidental. But if you've had a slow leak under your bathroom sink for months that you ignored and it eventually causes the floor to rot and mold to grow,
They might deny that claim?
they very likely could deny it, arguing it was a maintenance issue you failed to address, not a sudden event. Same goes for pests, termites, rodents, insects. Damage they cause is usually excluded.
Unless
Unless the pests cause a covered peril. For example, if squirrels chew through wiring in your attic and that sparks a fire,
fire damage would be covered?
yes, the resulting fire damage would likely be covered, even though the initial cause was excluded pests. It gets complicated.
Definitely sounds like reading the actual policy is key.
Uh.
Any other big exclusions? You mentioned something about pets earlier related to liability.
Yes, the dog breed exclusion. This ties back to liability, coverage E. Some insurance companies will specifically list certain dog breeds they consider higher risk. Common examples are pit bulls, Rottweilers, German Shepherds, Dobermans. If your dog belongs to one of these excluded breeds and it bites someone, even a minor nip, the liability coverage you thought you had for that incident might be completely void.
Wow. So you could be on the hook personally for medical bills, lawsuits?
Potentially, yes. You absolutely have to check your policy's exclusion section for any mention of animal breeds if you own a dog, especially ones sometimes flagged. Talk to your agent about it.
Okay, this is all incredibly useful for understanding the policy itself. But let's talk about actually shopping for insurance. Getting quotes. You said accuracy is key.
Crucial. Especially with one seemingly simple piece of information, your mortgage details.
The mortgage company info. Why is that so critical?
You can't just write down Big Bank Inc. You need the exact loan number and, more importantly, the correct mailing address for the insurance department or escrow department of the company that services your loan. Sometimes it's different from where you send your payments.
And if you get that wrong?
The insurance company might send proof of coverage to the wrong place, or the mortgage company never gets notified correctly. They might think you've let your insurance lapse.
Which could lead to them force-placing expensive insurance on you, or even foreclosure warnings.
Exactly. It's a common administrative headache that causes a ton of unnecessary stress. Get the mortgage info right up front.
Good tip. So once you have your info ready, the advice is usually to get multiple quotes, right? Like 3 to 5?
Yes, definitely shop around. Get at least 3, maybe up to 5 quotes. But don't just compare them based on the bottom line price.
What should you compare besides the premium?
Look at the whole package. What's the dwelling coverage A limit they're proposing? Is it enough based on current rebuild costs? What are the liability limits, coverage E? And really pay attention to the deductible they've quoted.
Ah, the deductible, the amount you pay out of pocket before insurance kicks in.
Right. A higher deductible, say $2,500 or $5,000 instead of $1,000, will almost always get you a lower monthly premium.
Which sounds good.
It can be if you can comfortably afford to pay that higher amount out of pocket if you have a claim. Don't choose a $10,000 deductible just to save $20 a month if you don't actually have $10,000 readily available in savings. Don't gamble with your emergency fund.
Makes sense. Balance the premium savings against your ability to pay the deductible. What about the companies themselves? Does it matter who you choose beyond the coverage and price?
Absolutely. You're buying a promise that they'll be there for you, financially sound and helpful, during potentially the worst time of your life. So check their reputation before you buy.
How do you do that?
Look at third-party ratings. J.D. Power is great for checking customer satisfaction, especially how companies handle claims. And check their financial strength rating from a service like AM Best.
AM Best. That tells you if they're likely to actually have the money to pay out lots of claims after a major disaster.
Exactly. It's a measure of their financial stability. You want a company that's rated highly for both service and financial strength.
Okay, so we've covered a ton. Let's try to boil it down. What are the absolute must-dos, the key takeaways?
Okay, number 1, understand your true replacement cost. Factor in that crazy inflation we talked about. Your coverage A needs to reflect today's building costs, not what you paid for the house years ago.
Number 2.
Know the difference between ACV and RCV, especially for your personal property, coverage C, and potentially your roof. RCV is generally better protection, even if it costs a bit more.
Right. And number 3.
Pay attention to the exclusions. Know what's not covered flood, earthquake are the big ones, and consider buying separate coverage or endorsements for those gaps, and for high-value items using scheduled property coverage. Don't forget that ordinance or law coverage for older homes, too.
Basically, avoid the big mistakes. Don't just buy the cheapest policy without checking the coverage levels.
Right. Don't set your deductible so high you can't actually afford it.
And read the darn policy, especially the exclusion section.
Yes. It needs to match your life, your risks, and the reality of rebuilding costs today.
So, given that things change, your stuff changes, building costs change, your risks might change. This isn't a one-and-done thing, is it?
Definitely not. The single most important action you can probably take long-term. Schedule an annual review with your insurance agent or company.
Every year.
Every year. Use that time to update your home inventory. Discuss current local construction costs and adjust your coverage A as needed. Review your liability needs. Check if you need to add or remove any endorsements like scheduled property. Keep the policy relevant.
That makes perfect sense. So our final thought for you, the listener, to chew on is this. If you haven't seriously looked at your homeowner's policy limits, especially coverage A, since before, say, 2020,
Given that 55% spike in costs,
you are almost certainly underinsured and financially vulnerable. So the question to ask yourself is, what is the actual current per square foot cost to rebuild a home like mine in my specific neighborhood right now.
Find out that number.
And then make absolutely sure your policy's dwelling coverage matches it. Don't wait for the disaster to find out you're short.